the rand strengthened its winning streak today, strengthening over 1% after the Reserve Bank cut interest rates by a further 50 basis points, citing low inflation risks. We now unpack the impacts that the latest interest rate cut from the Reserve Bank may have on the real economy with Isaah Mhlanga, the Chief Economist at Alexander Forbes, and Professor Brian Kantor, Investec Wealth and Investment. And Prof, just to begin with you, the market really liking the announcement coming out of the SARB today, the rand really looking pretty. What was your take on what the SARB had to say, and also its indication that, you know, there were another one or two interest rate cuts to come?
Yes, I would think they should come sooner rather than later. So, yes, one welcomes the market reaction. It's important. But my sense is that the Reserve Bank talks about inflation and in a conventional way, and yet the times are not conventional at all. So none of these forecasts have any strength. You can't really forecast into what will be a collapse in economic activity, what will be a possibly delayed recovery. To think there's any precision in your forecast is a mistake. It really doesn't ring well. What we need from the Reserve Bank is a statement, a clear indication of what they're going to do to help the economy out of this mess. Not about inflation risks. It's about real economy risks. And one needs a clear guidance on what the Reserve Bank itself, in combination, essential combination with the Treasury, will be doing to get us out of this mess, to ready us for a recovery. So, lower interest rates are necessary to the purpose. I think they should be lower still at the short end, and as much short-term borrowing should be facilitated by the Treasury as would be possible. So keep your interest rate expenses down as much as you can. So one welcomes
as much as you can. And Isaah, Certainly. Isaah, just to bring you in here, Prof. Isaah Mhlanga of Alexander Forbes, going into this, you wrote a piece to say that any cut that happened right now would potentially be too soon. You're of the view that the moves that the central bank had made up until today had been aggressive enough, and you thought that they should take a bit of a wait and see stance. Just unpack that for us, and also your view on their decision to actually go ahead with the interest rate cut today.
Certainly, if you look in terms of their growth revisions from minus 6.1 to minus 7% is very marginal if you consider the magnitude of the contractions. But also, if you look in terms of the inflation revisions, very marginal from 3.6% to 3.4% for this year, and it bottoms up and it starts to rise in the years ahead. And I would agree with Prof. Kantor to say, from an inflation point of view, perhaps they should have shown a deeper decline in inflation to justify the interest rate cut, but we didn't see that. And of course, the consumer confidence is going to remain quite depressed, and that is quite important for future inflation. As long as it remains depressed, it's difficult to see why would inflation rise in future. So the problem is not inflation; it is potentially deflation. But I thought, given the moves they did over the last 4 to 5 months, cumulative cuts of 225 basis points before today's cut, and also easing liquidity conditions, that is yet to filter through into the economy. And in any case, monetary policy also does not have enough tools to target a broader society, particularly those that are not leveraged, those that have been outside of the job market. They would never be assisted through monetary policy, which is where you require fiscal policy that can target those particular groupings in order to assist them.
And Prof, the governor was, continuing to stress that it's monetary policy alone cannot get us out of the situation that we're currently in. And if you look at the interventions that they have made in the economy since the COVID-19 outbreak began, according to National Treasury, it's totaling some 300 billion rand in collective stimulus. So sometimes you get the sense from the governor that, what else do you expect me to do? I've already done so much, and I'm even signaling that I could possibly do more by way of more interest rate cuts. How would you respond to that?
Interest rate cuts in and of themselves are quite helpful in stimulating spending, and we're going to need more spending to facilitate the recovery. So the economy is facing a deep reduction in output, and the output gap by any estimation is going to remain very wide over the next 2 years. So there's excess supply built in. So anything you can do to help demand, particularly when the economy comes out of lockdown, is helpful. So one of the ways you do it, you lower interest rates. Another way you do it is you create more money. So far, the Reserve Bank has not created any more of its own money to assist the spending. There is a link between money and spending. And at a time like this, the Treasury is under extreme pressure to fund this extra spending. And the central bank is in a position to assist. That's what central banks all over the developed world are doing. The Fed increased its money supply, its money base by 40% in the first 4 months of this
All right,
year. Now,
Professor Kantor, just to jump in there on your view, around printing money, because the finance minister was given this question, and he said that South Africa was not in the business of printing money. And also, the central bank hasn't just cut interest rates; they've bought bonds in the second, or government bonds in the secondary market. They've also lowered the reserve requirement for banks. So they've done a lot more than just interest rate cuts. So what else then? Can a central bank governor do in his capacity to help this economy right now?
Well, buying bonds is creating money, and the government has very large deposits with the central bank, which it will be calling upon, because other ways of funding the increased deficit, which is incidentally mostly because of lower tax revenues, not that much more spending. I think we need actually more spending, but the deficit has widened enormously. And funding that deficit is a real issue. So running down the deposits of the government with the Treasury deposits with the central bank is one way of funding, and that is money creation. Helping the banks by buying back their repos, supporting lending more to the banks, that is money creation. It is appropriate in these circumstances. You've got to do everything you can to help the economy out of a truly desperate situation. So don't talk about the outlook for inflation. Talk about the outlook for the real economy and what you as a central bank will be assisting the Treasury and the government in helping us get out of this deep destruction of income and output. And there's a stronger case.
Isaah, to bring you in here, for sure. Just to Prof, just to bring Isaah in for a second. Isaah, your views on making more money being available in the economy to have a better impact, or a bigger impact on the real economy. And also, just to add on to that, when do you actually expect some of the interventions that the central bank has delivered so far to have an impact on the man of the street?
Look, monetary policy loosening is going to help those that have, debts that are leveraged. Reducing debt repayments is certainly very good. But the problem with this idea that the credit lending channel is going to lead to a recovery in economic growth is simply quite flawed, at least in the next short term, because without a high consumer confidence, which depend on two things that are not related to economic policy. One, it is job security, which when you look across the world, many companies are closing down, and even in South Africa, a lot of companies are going to close down. Job security is potentially at its lowest levels in post-democratic South Africa. And the second thing is whether consumers are going to feel safe to go out and spend. And given the increase in infections, and if you check the health minister's projections of fatalities, it shows they are going to increase quite dramatically over the next couple of months. So consumers will not feel safe to go and spend. And as a result, whatever savings they make from lower debt service costs, they're going to save. So it's not going to translate into higher spending and boosting economic growth until the underlying healthcare problem is solved, which is why spending by national treasury directly into the economy is much more better option than using monetary policy.
Well, just very briefly, if we just hear from the governor a little earlier when he was speaking about the liquidity that the bank had injected into the economy by way of their bond purchases. This is what he had to say, particularly around the resistance to actually buy government bonds.
The bond purchases, as you have correctly pointed out, we are doing the bond purchases to smooth the functioning of the market. And so if we talk about how effective they had been, we have seen that they have actually been effective because the market continue to function. And let us be clear, we entered the bond purchases program with a clear intention of getting the markets to function in accordance with our mandate. The functions of the Reserve Bank is to ensure functioning financial. And when we saw a dysfunctional functionality in the bank, we embarked on that bond purchase program, and it looks like the markets are functioning quite well. We stand ready to deploy our tools should see that there is any dislocation that is taking place within the market.
And gentlemen, just final thoughts on the latest interest rate decision. Isaiah, just to begin with you, is particularly what you'd like to see at the next MPC to really bolster any efforts that have been put in place right now to cushion the economy from the COVID-19 blow.
Obviously, from a personal point of view, I do have a bond, so I would like interest rates to be negative or even zero, so that it can cushion myself. But it's not going to help, at least those that are outside of the labor market. What we need is to help those that cannot be covered through the credit channel, through commercial banks, because there is credit rationing which depend by and large by whether you are employed or not. And for that, we need fiscal policy to play a bigger role than monetary policy.
And Prof, final thoughts from you?
Well, monetary policy and fiscal policy at a time like this works hand in glove. The Treasury has massive borrowing to do. The long-term implications of that borrowing, the interest expense that taxpayers will have to be paying over many years, that's an important consideration. Holding down those costs, those interest rate costs, should be an essential target requirement of policy. Yes, monetary policy in and of itself, but in combination with fiscal policy, can facilitate the recovery of the economy when, in fact, the lockdowns allow such recovery. And the chances of a full recovery anytime soon are not good. Not at all good. It'll take time. And all the help the economy can get with lower interest rates, with more government spending, with tax relief, with lower interest rates, all grist to the mill of recovery. So, my question is: Are we doing enough? Are we aware of the full nature of the crisis? And the fact that we're in an emerging market with high interest rates does not alleviate the issue. It's the same issue, and you've got to address it aggressively, with confidence, with clear guidelines as to what your aims are to alleviate the crisis and to encourage the recovery when, in fact, businesses are allowed to actually produce more output and more income, and they will need demand to accompany their ability to produce more. So you need demand to move in line with increased supplies. And in the meantime, inflation, irrelevant. Real economy, all important.
Right. Prof, we'll leave it there. Thanks so much for your time. In fact, you gentlemen finishing off on a note of mutual agreement that it's about fiscal and monetary policy playing a stronger partnership during these times to really cushion the blow on the economy from the pandemic. That was Isaah Mhlanga, Chief Economist at Alexander Forbes, and also Professor Brian Kantor from Investec Wealth and Investments. And